What's up, guys? Welcome back to G-Tech Finance. So this is no surprise that investing throughout last year has been one of the most eye-opening experiences for so many people in a very long time. In a span of 365 days, we've seen some of the worst single-day point drops in history, followed by a 30 to 80 market decline, followed by the shortest bear market in history, followed by the largest point increases in history, followed by a brand new record all-time high. And now people are beginning to question whether or not the market has just peaked before we fall back down and experience it all over again. Typically, we could just chalk this up to normal market volatility and then move in with our day, but not this time, because throughout the last year, I've seen so many people make some very serious mistakes with their money that have easily cost them tens of thousands of dollars or more, and especially on YouTube. And if that's not bad enough, all of those mistakes were avoidable had they just been aware and known that not to do this ahead of time. And here we're gonna discuss about some common investing mistakes that you should not make. And best of all, this information comes at the low cost of the like button and subscribe to the channel. So let's get right into it. So our first stock market investing money trap is to get overly confident. So once you start getting overly confident about your ability as an investor, you begin losing your edge. It becomes easier to overlook issues, ignore the fundamentals, which is like watching the financials of the company, seeing if it's sustainable for the long term, and if it's a good company overall. And otherwise, you can invest without regard to the risks. And I think a little bit of humility will go a long way for every single investor, including Warren Buffett. And usually, the more you realize that you don't know everything, the more likely you are to make money. Second is getting impatient. Impatience ends up leading to impulsive, short-sighted decisions, and implies that you know how to best time the market. It reinforces that it's okay to sell once you get bored with a company for not constantly going up, which is bad. The reality is, patience is one of the best qualities that you can have in not only investing but also in life. Third is, do not over leverage your money. The point where people get in trouble is when they borrow too much and bury themselves in debt and don't have enough to cover themselves in the event of a market downturn, because when you take so much debt, it's a very risky move. It will either help you earn more money when everything goes up, but it will take much more from you when it's going down. And as long as the answer for you repaying your debt is yes, then you're okay. But once it's no, you're gonna have to start thinking about paying off debt, especially high interest, and it deserves preparing for. Fourth is, do not blindly invest. So when you jump into an investment because someone else gave you a tip, or because it's really short term, like some meme stock or even Dogecoin, who got the attention of media for like 2 weeks, skyrocketed and then came back down crashing, or because you trust what other people are doing, you're making an uneducated decision to basically trust that other person with your money when they have absolutely nothing at risk for being wrong, and you have your money at risk. If you feel comfortable handing someone else your money and telling them, here you go, make me money, by all means go for it. But if you wouldn't trust the person, that they're gonna have the passwords to your account and they're gonna control your money and all, you shouldn't follow what they do. Number 5, diversify your portfolio. So this means your whole portfolio isn't just crypto, or just real estate, or just a few individual stocks. Instead, you spread your money through as many different options as possible. Low budget index funds with, let's say, some crypto, some bonds, and there's a long way to go. Some angel investments, there's a lot of things you can do. Number 6, don't keep too much cash on hand. So that's because over time you lose money two ways. One, inflation lowers the relative value of your money by 1 to 3% per year, or you miss out on the profit you otherwise would have made if you kept your money invested. Instead, analyze how much you need in order to pay your bills for like 6 months, assuming all of your income went to zero. Keep that amount in cash as such a kind of insurance fund or emergency one, plus whatever else you absolutely need to sleep well at night, and then ideally from here invest the rest of the money. Now what you can do too is, if let's say you're waiting for like this super good investment opportunity, you can keep some cash on the side. When it comes, you're gonna be just ready to go for war. Means to say you're gonna be ready to just take the cash you have, go make the offer if it's a house or anything, and you're good to go. Number 7, and that's, I think you should know it, it's don't panic sell. So my rule of thumb is this: nothing has fundamentally changed about your investments besides it being down. But if it goes down, don't sell it, just buy more. Only sell an investment if the reason you bought it has changed and you no longer believe in the long-term outlook. But otherwise, you hold. And when it goes down, buy more, increase your position, because when it goes up, you're going to make more money. And you're going to make more money than before. And if you continue buying consistently, you're going to make more money. It's going to make more money, and it's going to make more money. And it basically never ends. So I think that's it for today. It was 7 really, I think, you can say if they're basic traps or not, but it basically shows you that last year investing screwed 99% of the people. So if you enjoyed the video, hit the like button, subscribe to the channel if you haven't already, and hope to see you guys next time.